G'day everyone, welcome to this weekly update for the 25th of May, and it's looking after the week that we've just had in America that we're probably not going to get a correction this time round. The US market closed at a new all-time high, and there really is a lot of impressive momentum in America. Some of the smaller end of the market still well off their highs, but look, the signs are reasonably encouraging. The Australian market is a bit of a different story at the moment, and we'll go through that. So let's have a look at the action last week. The S&P ended up gaining a pretty impressive 23 points, and for the first time closed at or above the 1900 level, which pretty much says it all about the momentum in the US market. Now, the economic data is certainly good enough. It's not fantastic, but it's good enough to support where the market is at the moment. And corporate profits have certainly reaffirmed what started to be priced into stocks during 2013. So stocks were priced up to a level that expected profits to come through in 2014, and that's certainly materialized. So everything there is good enough to support the market at the current level. And as you know, markets can push above fair valuations, and we may be in that process at the moment. The smaller end of the market, the Russell 2000 and some parts of the NASDAQ are weaker. They are off their highs, but they certainly seem to be stabilizing from oversold at this point in time. So the key thing for me is that markets are looking pretty positive overseas. The Australian market is a little bit of a different situation. But when you're trading, the only point about trading is you must have a significant advantage because you can't be sure that any trade is going to be positive. So you must have a worthwhile advantage, and where the markets are at the moment and at this time of year, which is traditionally a bit weaker, then I believe you need a bit more of an advantage than normal. And that means buying from oversold. Do not chase prices because you don't want to miss out. That is definitely not the way to trade this market at the moment. So let's have a look at the S&P. So first of all, we'll just take a step back, have a look at the big picture, and you can see the red line, the 150-day moving average, hasn't flinched. It's still heading up at the same angle that it was before, and the value of the index is still as far above the average as it ever normally gets. Now, I thought that it may have been running out of steam. As you can see here, instead of quickly forming a new high, as we'd seen all the way back through here in 2013, it dipped down towards the 150-day moving average, and then it bounced to a new high. It dipped and then a new high pretty much straight away. This time we dipped and then we formed basically a series of equal highs. So it really found resistance around this 1900 area. But if we zoom in and look at the last week, you can see it was a pretty impressive week and a new all-time closing high. Now, it's possible that it might just go up a little bit, you know, maybe to 1905 or 19010 and then roll over and come back in a more significant correction. But I've got to say, I'm particularly looking at hundreds of charts of US stocks, not just looking at the index, but looking into a lot of different stocks in different sectors in America. And there's just really quite amazing the momentum behind what's happening in America. So I think now there's a very good chance that we could push on, you know, a decent distance, maybe to perhaps 1950 or something of that nature before we maybe get a bit more of a pause. So very impressive in America, and you know, despite what we might think, you've just got to step back and look at the action and make your conclusions from there. Now, if we look at the NASDAQ, you can see the NASDAQ, the moving average, it just started to slow, just started to not go up quite so steeply, but as you can see, the NASDAQ is off again. Wednesday, Thursday, Friday, quite impressive, formed new short-term highs, and it's not very far behind the S&P index. When we drop down though to the Russell 2000, so we're talking about stocks from 1,000 to 3,000 market cap from the top, you can see it's much further off its highs, but really does seem to have stabilized around this support level just under 1100. And so there's every chance now that we might see a recovery in the small caps as well. So pretty positive signs in America. Let's turn to Australia now. The ASX 200 index only gained 13 points for the week. Our market very disappointing by comparison. And again, it's concerns over China that's providing a drag on our market, and not without some justification. I've been bullish on China for a long, long time. That's my fundamental bias, and I am aware that I've got a fundamental positive bias towards China. However, I've been looking in as much detail as I can find on the steel industry and therefore the iron ore markets, and really understanding how the steel industry works from a buying point of view, the issues that are coming up now with Chinese banks tightening credit and forcing some steel mill closures. There certainly are some concerning signs in China. Now, I don't think it's all going to fall apart. I just think that's not going to happen. However, we could be in for a protracted period of weakness in steel production and therefore in the iron ore markets as well. And that'll filter through to a lot of the other parts of the resource industry, and also filter through to the Australian economy in general. So I think that's going to continue to be a drag on our market until we see some more positive signs out of China, and that might be a little while. There's also issues in the property market in China. There's certainly some signs that things are slowing down, not so much in Beijing and Shanghai, but certainly in some of the tier 3 and tier 4 cities. And that'll have ramifications for raw material demand as well. So certainly some cause for caution in the Australian market. Now, the other dynamic that happens from time to time in our market is that particularly away from the top 20 or 30 stocks, is that market depth starts to get rather thin. There are less buyers in the market. People pull back. Liquidity continues to be an issue, and that leads to periodic, quite wild fluctuations in share price on very, very low volume. And we're seeing that now with some of the really high-flying stocks, some of the internet stocks that have done extremely well, some of the healthcare stocks that have done extremely well, that have more than doubled or so in the last year. What we're seeing now is some significant intraday fluctuations. And that's only because basically the buyers have stepped back and liquidity is very, very thin. So you need to be quite careful in Australia. Let's just have a look at the commodities, and then we'll go and look at the charts for Australia as well. Now gold, again, flat on the week. This is coiling itself into a really, really tight little band, and inevitably there will be a significant breakout from that band. So you can expect a volatility breakout. I don't have a high degree of confidence, the way precious metals are in the short term, that breakout will be to the upside. I think there's probably better than even money chance it'll be to the upside, but I would not discount a breakdown to below current support. So a fair amount of care needed in precious metals. Naturally, the GDX index, Gold Miners Index in America, is looking exactly the same way. So let's go over and have a look at those charts. First of all, we'll start with the Australian ASX 200. Now we had a bit of a rally on Wednesday, Thursday, Friday, but equally we had a pretty sharp down day on Monday. So overall, we only gained a tiny little bit, and compared to the American market, you can see how far off the peak we are. The peak, which was nearly 7,000 points, we're miles short of that. We're 25% short of that. Whereas if you look at the German DAX index, you look at the FTSE in London, they're all basically trading at their all-time highs. So the peak that we saw at 7,000, which was largely a peak drawn by the resource industry, and that occurred in October 2007, that is well and truly past now. And because the mining investment boom has certainly peaked and is rolling over, then I think our market as an index is going to continue to lag significantly behind the rest of the world. That's one of the reasons that I've been trading my personal money in America for more than a year now, and certainly with great success. Let's have a look at the materials index. Not a lot of change in the week. It pretty much reflected what the ASX 200 did, remained pretty much unchanged. If you look at the banking index, it had a little bit of a rise, but not much. So our market really pretty thin. And let's just look at the small ordinaries index. You can see here, it's really been flat for quite some time. Now, if we look at gold, it's the gold market, and you can see how tight this price action has become. So gold hasn't really done anything since the end of March. So that's nearly 2 months now, and gold has really not shifted, and you can see the action is just getting tighter and tighter and tighter. And eventually, if we go to another chart that shows the Bollinger Bands, you can see here the Bollinger Bands are really pinching in. We are going to get a breakout, and it's going to be a significant one. I believe there's a really good chance it'll be to the upside, and I would probably give that maybe a 60-65% chance of occurring. But there's also a possibility that it could be to the downside. Now, it would not break to the downside based on fundamentals. The fundamentals support gold being much higher, but gold is such a manipulated entity that you just never know what might transpire. So I think the best thing to do is to hold minimal precious metals exposure and wait and see which way it goes. Turning to silver, you can see it's the same pattern. We've got this big base here at $19 that started about 6 months ago. And again, you can see how tight these Bollinger Bands are getting. They've not been this close together for a long time. So again, we will see a volatility breakout and could go either way. Now turning to copper, continues to edge up to $3.17 during the week, and crude oil also pushed higher as well, which is pretty impressive given that the US dollar actually firmed a little bit during the week. So this is the 6-month spot chart on copper. You can see it based out in mid-March, just under $3 a pound, and now it's made its way back almost to $3.20 a pound. I'll zoom in just a little bit closer. This is the 60-day, so you can see the price action there. There's definitely a short-term trend over the last couple of months in copper. So looking at it from a strategic approach, the US correction looks highly unlikely at this point in time. After such a decent period, for the market to now be setting new closing highs, I think the market could very well push on. And when you think about it technically, there's a lot of people been waiting to see which way the US market is going to go. And now that it's closed at 1900, I think a lot of money will come in just from a purely technical perspective. So I think it's okay to raise exposure levels if you're trading in America. If you're trading exclusively in Australia, I'd still continue to be very cautious because of the issues around market depth and liquidity. You can buy good quality stocks, you can buy them after a sell-off, but there's got to be enough momentum to drive the price up. Otherwise, what's the point? If you don't have a chance of making a gain, then there's no point in being in the market. And gold stocks still basing in phase one, so I would continue to hold minimal exposure and only the highest quality gold stocks, and just forget the rest. So that's the summary for this week. It certainly revealed more to us about particularly what's happening in America. I keep harping on America because it really does set the tone for sentiment for the world, for all stock markets. So you can't trade in Australia and not be heavily focused on what's happening in America. So that's why I go into so much detail on the States. If you would like more information for non-members about what we do, you'll find information on our website. If you'd like to speak with me directly, then there's my email address. Always happy to do so. That's it for this week. Cheers.